Capital entered late, but when it arrived, it did not distribute evenly. One market absorbed a disproportionate share, not because it was simplest, but because it was already moving. The question is not why investors came, it is why they concentrated, and why that concentration reshaped the entire system. Before capital, there was infrastructure. Before infrastructure, there was constraint. Two layers already define the system: limited banking reach and alternative rails built on telecom networks. By the time external funding appeared, the foundation was not empty. It was fragmented but functional. Millions of transactions were already happening outside formal banking channels, unstructured, informal, but active. This matters because capital does not build from zero. It accelerates what already exists. Venture capital is not neutral money. It has requirements: speed, scale, repeatability, and most importantly, return. This creates a filter. Not every market qualifies. Not every system can absorb it. For capital to enter, three conditions must exist: visible demand, executable infrastructure, and pathways to expansion. Without these investment stalls, with them it compounds. Africa presented a paradox. Demand was visible, hundreds of millions operating outside traditional finance. Infrastructure was partially solved through mobile networks, but scalability remained uneven. Different countries evolved at different speeds, different regulatory environments, different payment behaviors, different levels of digitization. For investors, this fragmentation created risk. So capital searched for concentration. One market where all conditions aligned at once. That market was Nigeria, not because it was the easiest, but because it was the densest. Largest population, highest transaction volume, strong informal economy already in motion, urban centers with intense financial activity, and a growing base of technical talent. These variables compressed into one system, creating something rare, a market large enough to test scale within a single geography. This is where the system shifts, because once capital identifies a high-density environment, it does not spread outward first. It goes deeper. Funding concentrates into a small number of companies. Those companies optimize for growth. Growth increases transaction volume. Volume attracts more capital. A feedback loop forms, not evenly, but aggressively. Early-stage startups began solving specific problems: payments, remittances, merchant tools, digital banking layers. Each company focused narrowly, but capital connected them. Through funding rounds, through shared investors, through overlapping infrastructure. The ecosystem started to behave as a system, not isolated products, but interdependent layers. Here is where the open loop begins to close. Nigeria did not dominate because it was first, and not because it was simplest. It dominated because it reached critical density before capital arrived. And when capital entered, it amplified that density faster than any other market. Consider how this plays out. A payment startup raises capital. It expands merchant acceptance. More merchants increase transaction volume. Higher volume justifies further investment. New entrants build on top of that volume: lending, infrastructure, APIs, cross-border layers. Each new layer reduces friction for the next. Capital is not just funding companies, it is reinforcing pathways. This creates a structural advantage. Markets with lower density cannot replicate this easily, even if they receive funding, because capital alone cannot manufacture volume. It can only accelerate it. Nigeria already had it, fragmented, but real. That difference changes everything. Over time, global investors adjusted their strategy. Instead of spreading capital across multiple countries, they concentrated exposure in Nigeria, using it as a base, a testing ground, a signal market. If a model worked here, it could be exported. If it failed here, it was unlikely to scale elsewhere. This turned one country into a reference point for an entire continent. The result was not balanced growth, it was asymmetry. Funding rounds clustered in one geography. Talent followed capital. Infrastructure deepened in specific corridors, and the gap widened. Not because other markets lacked potential, but because capital prioritized certainty over distribution. This introduces a constraint. Concentration increases speed, but it also increases dependency. When one market absorbs most capital, the broader ecosystem becomes uneven. Innovation clusters instead of diffusing. Opportunities concentrate instead of spreading. And systemic risk builds silently, because the system leans heavily on a single node. There is another limitation. Venture capital requires exits, liquidity events, acquisitions, public listings. Without these, the cycle slows. In emerging ecosystems, these pathways are limited, which means capital must eventually confront structural ceilings. Growth can accelerate rapidly, but sustainability depends on deeper market evolution. So the system reaches a new phase. Infrastructure exists, capital is deployed, dominance is established. But the next question emerges. What happens when capital is no longer enough? When scale requires coordination beyond individual companies? When systems must connect across borders, not just within them? Because concentration solves for speed, but expansion requires integration. And integration is a different problem entirely, one that capital alone cannot resolve. And the next layer is not about funding, it is about networks interacting with each other, across countries, across currencies, across regulatory systems. The system is no longer local, it is becoming continental, and the rules are about to change.